the increase in prices overall is actually higher than the increase in wages. That hurts. That's just real.
It feels like we're living in a split screen economy. On one side, resilient markets, growth, and technological innovation and gains. On the other, high prices, disappointing paychecks, and general uncertainty. So, what's next for 2026? We don't have a crystal ball, but we have some educated guesses and some tips for where to find confidence. Hello, and welcome to Money on Your Mind from Edelman Financial Engines. I'm Michael Liersch, a behavioral scientist, financial planner, and your chief planning officer at EFE. Thanks for joining us for a conversation about how people are feeling about money, what they're wrestling with, and how financial planning can help you straighten things out. If you're watching this episode, you'll notice we're in our new studio space today. As it happens, a little change is fitting right now as we're talking about transitioning to the second half of 2026 and what it means for you. For that, we're welcoming back Katie Klingensmith, Chief Investment Strategist at EFE. Katie, thanks for joining us for a mid-year update.
It is a pleasure to be back on the show with you, Michael.
Well, and Katie, your episode ranks as, or actually, you've been on a couple episodes, technically speaking, some summary ones, some with our chief investment officer, some on your own. And your episodes rank as some of our more popular. So I'm really excited to have you back, especially when we think of this really event-filled first half of 26. So I'm going to pull a little bit of an audible. We didn't really plan for this, Katie, but that's what the podcast is all about. Tell us how we should, in retrospect, think of the first half of 26.
Michael, thank you for those kind words. And it's great to be back. There's a lot to digest right now. And I think if we had had this conversation at the end of the first quarter of 2026, it would have had a very different tone. Because even just a couple of months ago, we were reeling from yet another round of political headlines that felt really negative for investing. This time around, it wasn't tariffs. It was about gas prices, energy prices, and disruptions that we have been experiencing in the flow of energy through the Middle East. But now, halfway through the year, it's a different story. We've actually seen equity markets up almost 10% the first half of this year. And that's after so many headlines and so much volatility. But just as you started out saying, Michael, we both have a lot of good news right now. We have equity markets doing well. We have a lot of great earnings from US companies. We're seeing some of the political headlines start to look more positive. At the same time that we observe that a lot of Americans are experiencing anxiety and the pain from higher inflation. So it's a complicated moment after a very volatile first half of 2026.
So I'm going to kind of flip the frame here because I was going to start with, well, let's kind of focus on the good stuff and how that's going to carry itself into the second half of 26 in terms of your outlook. But I'm going to actually flip it. And let's start with the bad stuff, and then we'll go to the good stuff. I know, but I just told you it was $116.02 to fill up my gas tank on a family trip this past weekend. And that hit me pretty hard in terms of energy prices, which you alluded to, inflation, which you also alluded to. Tell us what can we expect now and for the second half of 26 in terms of how all of those more challenging dynamics are going to affect our thoughts, feelings, and ultimately our pocketbooks.
This kind of speaks to the mixture that we're seeing in what's happening in the economy as well. If we're going to start with the bad, I'll just say that inflation is real. right? Like, there are a lot of different measures of inflation. We know that it's much higher than where, Fed and other officials want it. It's much higher than any of us like it. And we know that that is really hitting Americans and they're feeling it. So I want to just recognize that from the numbers that we saw in April for the first time since the pandemic, that inflation, the increase in prices overall is actually higher than the increase in wages. That's to say things are getting more expensive quicker than your paycheck is going up. So that hurts. That's just real. And even if there is currently good news about potential flow of energy out of the Middle East, we still will likely see higher energy prices and all the ripple effect from higher inflation everywhere for a while.
And so when you
Michael, I
think
would
about, well, really quickly on that topic of inflation, so uh, I'm with you. It's just, I kind of told everyone about my tank and the price of it being filled up, and I think everyone's had that feeling, that going out to eat, all the way to big purchases, some that aren't discretionary or optional, right, Kitty? Like you got to do it. You got to fix that roof or buy that piece of machinery that broke. Buy that new car. So tell us, how does that actually then materially affect our financial plan, our investment plan? What's your thought there, just so that we can at least all set our expectations for the second half of 26?
Well, let's break that down into two parts, Michael.
Okay.
On the one hand, we think about our spending.
Okay.
And while some of our spending may be discretionary, as you noted, lots of our spending, if it's on big ticket items or just buying groceries, the daily flow, we don't have a lot of discretion. We have to spend some of that money. And it's hard when prices are going up. There can be elements of that in our control. We can think about what purchases are discretionary, if we can, time or delay certain things, which isn't always good, but we can, think that through when we have to tighten our belts. The other side of it is the investment side. And there we've done a lot of work, and we've published an article as part of our mid-year outlook showing that inflation can be tough. Historically has been a headwind for both equity markets and bond markets in the short term. And while inflation can take a while to really come back down, prices don't really ever tend to get lower, but the rate of increase can slow. We tend to see our investments do well after inflation has come down. So I can't promise you that everything will be fine. I never can. But history would suggest that inflation doesn't necessarily make for a bad investment outlook outside of the short term.
Okay. So while it may stress our pocketbooks, really sticking with our investment plan could ultimately lead to a beneficial outcome for the disciplined investor. Is that right?
It's extremely important, and that's exactly right. We can control what we can control, but we don't want to take those more expensive prices as a push to change how we're investing. We want to invest for the long term and know that inflation tends to come and go. And when it goes, our portfolios often do well.
So tell us how this all maps to the value of the dollar.
So let me say something kind of obvious. The value of the dollar. Like, how do you measure the value of a currency? And you can think about measuring the value of a currency in terms of its purchasing power, our fancy word of saying how much you get with that dollar. And that's basically inflation. And when we talk about the value of a currency, it's that currency relative to another currency or relative to all the other currencies. And when the dollar goes up, it means that we're able to buy more of those Japanese yen, those euros from Europe, Mexican pesos, everything else. When it goes down, we can buy fewer of those currencies from those other countries. And I think that's been a real source of concern. Now, 2 points here. First of all, we do not think that the dollar is suddenly going to lose its status as being the most dominant currency in global trade and the primary currency in which other people save money. There would have to be an alternative. It would hurt everybody to see a radical shift. We think it's unlikely. We wrote about this going into 2026. On the other hand, the events of the past 6 months have shown that the dollar doesn't have quite the same strength during times of stress, which may in part be to some of the long-term concerns we've been talking about a lot.
What would you suggest people, human beings, investors do about that? Is there anything to do, or is it just something to pay attention to in the second half of the year?
Michael, I spent a decade of my career working on currencies, and I'll tell you, it taught me a lot of humility. We as an industry are not very good at really getting a forecast right about exactly what will happen. But what we can do is build in diversification to our portfolios. And we learned from 2025 that having within our portfolios investments in other countries and in their local currencies can be an offset to when the dollar's not doing as great, or when US companies, for whatever reason, are not doing as great relative to others. So more than anything, what we can do is not try to tactically adjust or sell the dollar, but build in that array of different investments. We talk about that with stocks and bonds. It also really holds true for having some portion of the portfolio in foreign stocks and bonds.
So let's get to the really happy and good stuff that people should be
Good, I'm
paying
ready.
attention. Now you can see why I did this order, Katie, right? It's nice to go from, the frame of to yes. So what's your thought there?
So there's a lot of good news going on in the U.S. economy right now.
Great.
I mean, I
Let's
would
hear
just
it. Give
start
it to us.
That's right. I would just start with the level of growth and the revenues that we've seen from U.S. companies, and a lot of that is a tech story, not necessarily just in traditional tech stocks, but it's been pretty remarkable. And I don't think there's any particular reason to think that that's suddenly going to stop. So I think that's exciting. There's complexity there, but I think it'll be an economic transformation that will give rise to any number of new companies going forward and is nowhere near coming to an end.
So when you think of that growth, how does that benefit the everyday employee at a company, a business owner, a retiree, who's most likely an investor and living off of their portfolio?
Well, so I want to add a little bit of the split screen back into here, Michael. I
Okay.
mean, I'll
Deal.
lean into the good news, but we're also hearing a lot from clients around job anxiety
Okay.
and saying, okay, well, I get it. There are these companies, companies that are just launching their first public offering, or companies that are longstanding but have been embracing this new technology and are doing well. Hardware companies, software companies, all sorts of different innovators. But I'm also hearing a lot about how that's displacing jobs. And there have been some, I live in San Francisco. There have been big headlines and plenty of people I know who have lost their positions at big tech companies. And that feels hard. One of the things I really see in the data, and I expect to see more of this going into the second half of the year, is change. But it's not necessarily just destruction, it's creative destruction. There have been layoffs in tech companies, but the job market overall is quite healthy. Unemployment has been very stable and not particularly high. And the US economy has generally been adding quite a few jobs every month. It's just that they're not currently in tech. So I want to lean into that story of AI being transformative. There's a lot of change happening in how people work and where they work. But I don't think that we've seen any indication that that's some sort of end of work because of AI innovation.
That's interesting. So what we're really seeing, at least at this time, and for just to keep as a watch item for the second half of 26, is how jobs, roles, skills, the demand for those things will shift and change as artificial intelligence becomes more embedded in just the general environment in corporations, in small business.
It's interesting how we've just psychologically, all of our modes of interacting, productivity, to be fancy about it, has been transformed by this default technological platform. I think we're in one of those big periods right now. So that's about where we work, what kinds of jobs, how we work, how we live, how we interact. There's so much, and we all have our opinions, but there's so much good there, and there's so much change happening that I don't know that it's going to normalize in 6 months. We're going to continue to stretch and learn and grow. But I think that as part of that, we'll see many companies continue to add value in new ways. And we'll also see many employment opportunities that we hadn't been able to envision a few years ago.
So let's get into the two questions that we always like on this podcast. But before I do that, I think we've raised a lot of things that Some things sound exciting, but most of it, honestly, Katie, sounds pretty uncertain for the second half of 26. How would you give the investor, the person planning or trying to keep to their financial plan, confidence in the second half of the year? What would be your words of advice before I move to our two questions that we always ask after every episode is almost ended?
Michael, let's go back to how you introduced this conversation of having a split screen economy. What we experience in our lives is real, and there's an emotional component of it, but there's also a numerical component. It costs more to buy a car or buy groceries, and we have to adjust accordingly. But what I would urge people to do going into the second half of this year and in general is to understand that so many of the big changes and the stresses happen over a long period of time. And that it's really important to not make knee-jerk reactions to what we're experiencing in the day-to-day to how we plan for the future. But more than anything, I would try to separate out what we can control, our lived experience, it's valid, and our long-term plans, and understanding that the planning that we do, the investing that we do to achieve those long-term goals, it is rarely materially impacted by that short-term reality.
Well, that's actually very comforting and just factually accurate. Every year there's something, Katie, which is effectively what you're highlighting. And then we go through it would seem every half a decade, every decade, a period of disruption, either financially or in business or, with technology. So that knits for me, and I appreciate that. So let's get to one question that just everyone loves, which is, what's the biggest mistake you see clients making right now? And maybe we pivot a little bit. You can say that, but what you would really encourage them to avoid in the second half of 26?
Don't think that you know when this time is different. I think particularly coupled with the politics that we have seen over the last couple of years,
I see.
everyone has a strong personal view. And that is absolutely valid. There are so many important policy issues at play. There are so many questions around how we live. There are massive technological changes happening at the same time. But it is incredibly important to keep the focus on the long term and know that planning for the future is about being aware of short-term changes, but not trying to identify when one thing happens to be different, because much more often than not, we're going to get that wrong.
Got it. So this gets back to, time in the markets. Don't try to time the markets based on, these signals that may just be noise and not actually signals. So that really resonates with me. So let's end with our final question. Everyone wants to know, what's the one thing they should be doing in the second half of the year, no matter who they are listening or watching this podcast?
Right. So I'm going to go to a topic that I know we're going to cover more going into the fall,
Okay.
but everybody's going to be paying attention to the elections.
Okay.
And what I would urge people to do is pay attention. It's part of our civic duty, and it's fascinating. Know that there are so many different policy issues at play that, of course, make a difference to investing long term. But I really want to emphasize that we should separate out that political fervor from the way we invest. We see a lot of volatility around elections themselves. And again, a lot of serious and insightful analysis around issues that are at play in elections. But I want to urge us to think about the geopolitics that influenced the first half of this year, made for a really bumpy ride, and to remember that we came out overall ahead. Can't promise that for the second half of this year, but I want to emphasize that all of those different political, geopolitical topics, interesting, important, personal, but not appropriate for short-term tactical reactions in a portfolio.
Well, what is it that we say here at EFE? Money is green, right? It's not blue or red. And
That's
that's what I
right.
hear you saying.
That's right.
So let's focus on the money, and we're financial planning, and what is the best way to approach money to achieve the desired outcome. So I think that's very sage advice, Katie. It's just always a pleasure. interacting with you. I feel lucky because we get to hang out all the time together and dork out on all topics, markets and financial. So thank you for doing that in front of thousands of people with me. I appreciate it.
Such a pleasure. Thank you so much.
All right. We'll talk to you soon, Katie. That's everything we have for today. This has been Money on Your Mind. Thanks again to Chief Investment Strategist Katie Klingensmith for joining me. We'll be back next time with a new episode. Subscribe to the show on Spotify, Apple Podcasts, or YouTube so you don't miss it. I'm Michael Liersch from Edelman Financial Engines. Talk to you next time.